As far as I'm concerned, the views and opinions of financial news media might as well be toilet paper.
Off the top of my head, considering you're leading me on this, so I know you're up to something.
It's worse than you think. It's a lot worse than you think.
Maybe better off trying to predict a bear market once the market gets down to 10%.
All right, guys, welcome to this video, a very special video. In fact, we're joined here by our good friend and trader, Charlie Burton. And what I'm going to talk about with Charlie is we're going to dig into this data you're seeing here. And it has some special meaning because you see, guys, the mainstream media, a lot of people out there, they're very fond of a specific definition of a bear market. But I'm going to show you what the data, what the statistics actually says about this definition. And what does it mean for the stock markets? And what does Charlie think is happening on the chart of the stock markets? Let's talk about it, guys. Join me. All right, guys, welcome back. So we are, as I said, joined here by Charlie Burton. Guys, before we dig into the charts and before we look at the data, let me first of all say that, again, Charlie Burton, again, he's been a friend of mine for almost 14 years. And he's been a successful trader now for nearly over 20 years. So do check out his website and do check out the special deal that Charlie has. So again, you get, for 30 days, you get free trial of all his gold membership, which includes a free access to his trading room. So go to that link you see there in the description. It's just charlieburtontrading.com/LT gold. So make sure you go ahead and check it out. Okay, let's go on to the main section of this video. Charlie, what I want to talk about in this video is something that I think most of us have heard about. I think the mainstream media, the financial news media, I call it the garbage media because, I mean, as far as I'm concerned, the views and opinions of financial news media might as well be toilet paper. I know this is a little bit harsh, but that's how I feel. But the thing is, the financial news media absolutely loves this definition of a bear market, which is the 20% rule. I think most of us know what that means, the 20% rule. Essentially, what this definition says is that whenever the stock market, like the S&P or the Dow, whenever the stock market drops by 20% from its all-time high, so if you see, according to this definition, this belief, that whenever the stock market sees a 20% drop or decline from its all-time high based on closing prices, okay, then you have a bear market. Essentially, then you have a confirmed bear market. Now, that's the mainstream view. That's the overall majority view of people out there. And I'm going to call this the 20% rule in this video, about a 20% decline. Now, Charlie, what do you think is the statistical data or the statistical performance going forward of this 20% rule? In other words, what do you think is the win rate of the 20% rule? By win rate, I mean, statistically speaking, historically speaking, how successful do you think this 20% rule is in giving us a bear market definition? What do you think? Do you think it's a good definition, a really good one? Do you think it's mediocre or really bad? What do you think before we look at the data?
Sorry, so taking a 20% correction or bear market, as it's called. So I'm sorry, I'm just trying to understand the question. So
yeah, so the question is, sorry, Charlie, it's my fault. So what I'm trying to say is the mainstream view is that 20% drop from the all-time highs is a bear market.
Okay.
Now, by a bear market, that presumably means that we're going to see continued follow through and a bigger drop lower, like 2000. I mean, for me, when most people think about a bear market, I think most people mean a long-term one, or at least a medium-term one, like in 2008, the Great Recession crisis of 2008 and crash, or the dot-com crash of 2000, 2001, 2002. Okay, or the 1970s bear market. Okay, so overall, by bear market, I think most people mean something much more severe than just 20%. I mean, we're talking about maybe 40%, 50%, or 80% decline in the stock market. But my question to you is, historically and statistically, how successful is this definition of 20%? In other words, how good is it in predicting a much bigger crash of a big bear market? Or is it more likely to be a false signal? Nothing more than just a quick false signal before we go higher again, before we make all-time highs. Which one do you think is more likely after a 20% decline?
Okay. Off the top of my head, considering you're leading me on this, so I know you're up to something. So I'm going to say, actually, because a lot of the time, you think you're right. By the time a market has corrected 20%, it wouldn't surprise me if 50% of the time that it gets to that sort of level, that it doesn't go much further before it's actually finished. and then is then back off to the races again. So I think I know where you're going with, but I'm going to take a guess that about 50% of the time, it's actually, by the time it gets to 20% or 22% or 23%, it's there or thereabouts and bottoming, and it doesn't continue much longer. So, okay, go on then. Am I right? Or
let's
how
look at the
close
data,
am I?
guys. I'm going to show you. Actually, Charlie's onto something. He's absolutely correct. In fact, I'm actually going to show you, Charlie. It's worse than you think. It's a lot worse than you think in terms of statistical probability. So my question really is about statistical probability of how good is it as a bear market definition. Have a look at the data I've sent you, Charlie. Now look at the data. I don't know if you can see it now. And I'm going to put it for you guys so you can see it as well in the video. Have a look at that data on your chart, Charlie, and you will see, and guys, look at this. You will see that it is true that in certain years, like in 2008 and into the year 2000, so I've put that in the red box. So it is true in those years, it was a good predictor of a bear market in the year 2008, or we can say 2007, 2008, and also in the year 2000 as well. It was a good predictor of a much more prolonged, crash in a bear market. They continued, in fact, the markets crashed by 50%. The same is true about the 1970s. Again, in the 70s, it was a good predictor of a bear market crash. However, and this is something the mainstream media never talks about, but we're going to talk about it. We're going to reveal it. In fact, see that this definition of a bear market, 20%, is no better than a coin toss, no better than flipping a coin about 50-50. In fact, you will see, guys, here, check this out. And Charlie was onto something here. He's right. By the way, you will see that there was another, obviously, a bear market in the 30s. The one in yellow, the one I'm highlighted in yellow, the reason is that was just very flat. It wasn't very negative. It wasn't very positive. It was just very flat. So I put that in yellow. It doesn't really mean anything. But the green boxes are positive returns, meaning the market bottomed and went higher. The red ones is when the market saw a bigger crash. In other words, in the style of a recessionary bear market, a much bigger crash. And you will see the percentage positive. You will see that really in the first month, it's about 50%. 6 months later, it's still 50-50. Again, you look at the percentage positive shows in 6 months, it's still 50-50. But within the 2, 3, and 1 year period, it's much worse than 50-50. Okay. If you look at the 2 months, 3 months, and the 1 year period, again, 75% of the returns are actually positive, which means only about 25% were negative. Okay. If you look at the 1 year period, 67% was positive, which means really about 33% were negative. So it's worse than guys. What I'm saying here is this. In fact, Jason Geppert himself says this. By the way, this data is courtesy of Jason Geppert, and he says himself. He says there have been many other 20% drawdowns. Most recovered quickly, and you can see many of them. Many of the 20% declines coincided with a bottom in the market. And yes, there were some that led to a bigger crash, bigger recessionary bear markets. Guys, my point simply in this video is this. My point is not that we're not in a bear market. We could be in a bear market, okay? My point is not that. My point simply is that the 20% definition is not very good, okay? The 20% definition of a bear market is terrible. It's worse than flipping a coin for the obvious reasons I just shown. Statistically, it's not a very good predictor of a bear market. It doesn't give you a high probability of the fact that we're in a prolonged bear market, because the odds are 50-50 or worse, as we've seen here. The odds are not that great in predicting a bear market. Okay, that's really what I'm saying. It's not a reliable predictor of a bear market. So I'm going to go to Charlie here. Charlie, were you surprised by that? And that's my first question. I think you weren't. I mean, you got it right when I asked you. I think. What are your thoughts about that?
Yeah, I think that actually, what it's saying to me is that you're better off trying to. Maybe better off trying to predict a bear market once the market gets down to 10%, and predicting getting it to 20%. But yeah, no, it's interesting. I mean, I think the natural bias of the stock markets is to the upside, as we say. Historically, the stock markets are inherently geared towards going up. They spend more of their time going up than they do going down. When they come down fast. The average length of a bear market is anywhere sort of on average 18 months to 2.5 years on average. The average length of a bull market is twice that length at least. So the stock markets are geared that way anyway. So as Warren Buffett always says, you make your money when the when there's blood in the streets. So
Yeah,
rather than anywhere else. So and he demonstrated that yet again in the 2008-9 period, didn't he?
he did. So Charlie, I want to go. My second question to you is this: do you feel? I mean, based on what you're seeing on the charts generally, do you feel that a bear market has started in the stock markets and that a recession is now likely by the end of this year? I should say, guys, that a lot of the data is very conflicting. There are some data that suggests that a recession may begin sooner than we think and that we are potentially in a bear market. But there's a lot of other data that suggests the exact opposite, that we may not yet, that it may be too soon to call a bear market or a recession. Okay, so it's not confirmed. In my view, it's not confirmed yet. Okay, but I want to get what Charlie thinks about this. What are your thoughts?
My general thoughts are one is people shouldn't be scared of bear markets, because bear markets actually present great opportunities. When there's more market volatility, if you know what you're doing as a trader, then there are greater opportunities out there. So one is not to be scared and fearful. And in fact, as we just quoted Warren Buffett, sometimes when the majority are fearful, it's the best time to actually be stepping up and actually starting to invest into the markets if you have the means to do so. So in that regard, I think it's not something to be scared of. As far as the markets are concerned, and as we know, by the time there's a recession in the economy, quite often the markets might actually be in a bottoming process. So the economy, from an economic figures perspective, from a GDP figures perspective, that by the time those GDP figures go negative, the stock market may have already bottomed by then. So the two are not mutually exclusive, and between recession and bear market. But certainly when it comes to it, my view, and this is just an opinion, of course, I think the thing for me at the moment is the considerations that we've got at the moment. And as you say, there are considerations at the moment from all different sides. But a bear market, as you know, and a recession is deflationary by nature. So the high inflation figures that we've been seeing should start to come down. If that's the case, if we are starting to see a cooling global economy, we are seeing global PMI figures are coming down, but we don't know yet where that stops. Do we end up having a recession or not? Is it just a cooling of the economy? My view is that we've got a lot to work through at the moment, and I think there's an adjustment as far as a lot of companies are going to be going through adjustments as far as their future forward projections, earnings projections are concerned. And so my view at the moment is, I think it's personally unlikely that the stock markets have bottomed just yet. And so that's my personal view on it. But of course, that's what the markets are all about. We've done this plenty of times before, and only time will tell us if that's the case.
All right, guys, before we finish, Charlie, tell everyone about the free trial to your membership, of your gold membership and your gold service. Again, please, guys, do check it out, as I mentioned earlier in the video.
The one thing to mention is when they go to that web link that you've given, by all means check out all the information on there, but it's only once they click through, that's when they get a coupon code, and it gives them the coupon code. It's all linked to that link that we've created for you, and specifically for your followers here on YouTube and the like. So coupon code itself is LT 30 days, but it says it on there. Once they click through, it's there in broad daylight for them. Pop that in, and then it'll take the price to zero, and that's what they need to do. So it's a specific. We don't do deals like this. This is, you've bent my arm several months ago and said, "Come on, what can you do?" And so
that's right.
There you go.
It's true, guys. I did bend Charlie's arm some months ago, and I said, "Charlie, could you please give our subscribers a taste of your gold service?" And yes, guys, please do check it out. Charlie, tell us more about what they can get as part of that gold service.
So they get access. I have a live online trading room, so you can just log in from wherever you are in the world. I have specific sessions in that trading room throughout the week, from morning analysis sessions, evening analysis sessions, and any of those sessions I might be placing trades, of course, as well, because I'm authorized to be able to call trades. I'm regulated here as a fund manager here in the UK, but right away through to A lot of education as well, technical Tuesday sessions, mindset Monday sessions, throwback Thursdays. We have lots of themes within these sessions. But even if people can't make the sessions, then every one of those sessions are recorded and they're held on the software there. So you can log in at any time you like, pick up the recordings, and because it's a learning environment, it's a supportive environment. I've been trading 24 years and I'm trying to really encourage people to utilize these sorts of resources that we have to bring up the standards of trading that at least I can influence. And so that's what we're doing there. So it's a completely learning environment. There's lots of material. There's 12 hours worth of pre-recorded stuff for them as well. There's an app they can download and they get my trade alerts on that. It just goes on. So it's a huge amount. And they're going to get all that for free for 30 days.
Great. Thanks very much, Charlie. Guys, please do check it out. I'll put the link for you guys in the description. See you guys in the next video.